Interest rate pressure will be the theme for bank earnings season this time around. When interest rates were rising, it was all great news, but now that they're falling again, it raises a lot of concerns about how you grow revenue. It's hard for investors to get excited about the flip side of that story, which is cost cuts, because that's what the CEOs are going to be focusing on. What will expense control look like this time around? We've already gone through it many, many times. How difficult will it be for these executives to pull it off and get investors excited?
Well, you're absolutely right. We are, by the way, officially neutral on the bank sector for exactly what you're talking about. Now, they did take a hit in October, so they're cheaper than they've been previously. We think earnings are going to be up about 4%, but we do feel that we're going to start to see the near term continuing for the foreseeable future effect of compression in net interest income margins, which is exactly what you just talked about. Yes, the response to that is always to cut costs. Banks seem to cut costs periodically, every couple of years. It'll look like it has in the past, but we're worried that we might have seen in this last quarter, maybe the peak in bank earnings for quite some time because of the importance of net interest income margins. However, the good news is, and banks are like the canary in the economy coal mine, no signs of recession. Loan growth is still going to be healthy. Credit quality is still going to be healthy. So if you're looking at banks to tell, are we nearing stall speed in our economic growth, I think you're going to be reassured.
John, really quickly, do you think we're going to have some consolidation in the U.S., more consolidation in the financial space?
Good question.
I think going forward, consolidation in many sectors in U.S. financial services industry is a given. There are disruptive pressures, cost pressures across the board, and smaller firms are going to have trouble responding to that.